So this video was inspired by a comment left by Tommy Soto on the last video I made about my stock purchases this month. And it reads, "Great video. As someone just starting to take control of their finances, I have some questions. Pardon me if I sound like not saying that because of demonetization. I've done my undergrad/master's degree in accounting, and I still barely understand how to get into the game of informed investing. I wouldn't beat yourself up too much. In fact, that's one of the best backgrounds you can have. It's not perfect, it has some drawbacks which we'll get into later, but you're better off than most people. I know it's important to be informed, but how do the majority of people go about investing their money? Oh, by the way too, I actually have a background in accounting as well. I studied it for 2 years in university. I ended up pivoting into something else. I didn't finish it, but I have a pretty strong background in accounting for that and also for other reasons that I won't get into. I've worked in an accounting capacity for 2 companies, but I don't really need to say much more than that. Anyway, back to your question. So on how do the majority of people go about their investing their money? I mean, the fact is there really is no clear majority. I mean, you have people who invest by way of speculating on Bitcoin, and then you have people who invest by shoving everything off to a money manager or a wealth manager. So there's no one way people do it. You go on to say, do they just hand it to a fund manager and say, here you go, make me money? Some people do. Some people would much rather focus on their career because they're making a lot of money there, but getting to the nitty-gritty day-to-day of managing money, that's not for them, especially if you're let's say you operate a manufacturing plant or something like that. Investing can be tedious. I mean, you know this from having studied accounting. It's like learning the tax code and why many people put off their taxes to a professional. For a lot of people, they just don't have an interest in it, or they don't have the time, frankly. My job is YouTube, so I do have the time to micromanage my investments, keep up on the news, read the filings, do all that. So that's why I personally control it. But yeah, some people do delegate that task to a fund manager. I don't see much conversation around financial ratios or metrics in regards to company performance. The general trend I see is people mentioning the recession, speculating on what the next big industry is going to be. Why is that? Is that a smart investing strategy? Well, no, it's not. I mean, frankly, if you're watching a channel and they don't have a command over, the financial ratios, as you're saying, or it's obvious they've never read an SEC filing in their life, I guarantee their advice is not going to be good. Now, that being said, financial ratios are not the be-all, end-all. I think everyone should understand the minimums, PEs, free cash flow, revenue, EPS. I'm talking like the basic. Even just market caps. You'd be surprised how few people understand that. Most of how a company is going to do, if you're being much more speculative, is that you need to understand, alright, so future revenues likely will be this according to my model. How is that going to affect the EPS? How is that going to affect the share price? Such as that. What those other people are doing, as you're saying, mentioning recession, speculating on the next big industry, to be very charitable to them, because there's a little bit of like me in this as well. That's what I like to call qualitative investing. And what you're talking about is more quantitative investing, right? So again, mapping out revenues, looking at the cash flow, everything that an accountant would understand by going through the SEC filings. And that's really important. I mean, especially let's say you're looking at an OTC stock, over-the-counter penny stock, you need to understand how is this garbage, and the best way to do that is actually to read the SEC filings, and too few people do that. But you also know too that financial statements aren't everything as well. So I will tell you another thing. I have a background in history, right? And so let's say if you were to look at the First World War, or even better, the Second World War, I could give you a metric for how many civilian tractors each country produced, and then you could say, well, according to this ratio, that ratio, this country is guaranteed to win the war and this one isn't. And obviously there's a degree of truth to that, but if you only had the ratio of how many tractors the country produced, you couldn't tell them who was going to win the Battle of Kursk, right? And so, just like with history, you kind of have to understand the implicit patterns and the qualitative aspects to it. So, how good is the management team? What do you think the company's strategy is? What's the current political environment? All of those, just a few examples of many, all of those are qualitative elements that you need to keep into account when you're investing. And frankly, if you're only relying on an accounting background, you're being left behind. But then at the same time too, that can lead to these really bad downside scenarios where a lot of people on YouTube, they're just dumb and wrong. I mean, I'll give you an example. So I'll compare the two lines of reasoning. The line of reasoning I have on my channel about gene therapy versus, let's say, the common one where, I guess a year ago, people were speculating that Bitcoin and weed stocks were going to be the next big thing, right? So here's the line of reasoning on why people thought weed stocks were going to boom, and spoiler alert, they didn't. They're all doing terribly. Anyway, generally the reasoning went like this. Reason number one, weed is extremely popular. I guess I should give up on ever having this monetized. Anyway, reason number one, weed is extremely popular. Reason number two, the general political trend is to legalize marijuana. And then reasoning number three, therefore, the entire hypothetical weed industry is worth this many billions of dollars. Therefore, this one company I found on the stock market is going to be worth, however hundreds of billions of dollars. It's a 200x, right? But it's missing a few key aspects to that calculation, which are, number one, what are the big old style players, right? So will the big tobacco companies get into it? Number two, how heavily will the government regulate it? Just like many countries run government liquor stores, is it only going to be allowed in a small scale, kind of like the vaping industry? You notice the vaping industry really failed to achieve massive conglomerate status. Most of the little operators were independent in sourcing their own product. So a lot of things can go wrong with that type of qualitative thinking, but also too, it can help you out a lot. So like in my case, yeah, I do believe I also speculate on the next big industry, kind of speculating, and mine is gene therapy. I think though in my case, the idea of pharmaceutical startups starting from, preclinical to launching their commercial product and then eventually being bought out, that's a well-established commercial trend in the industry. I mean, again, even with conventional pharmaceuticals, pharmacyclics, the other ones are escaping me right now, but that's a very, very common path in the pharmaceutical industry to go from, again, new treatment, new therapeutic, to commercial launch to buyout. And also with my calculation too, a lot of this is more baked into science, right? So you read the clinical trials and it either works or it doesn't. And also too, frankly, my way has been paved by reality. Again, I pointed in the previous video, gene therapies, it's still very early, mind you, gene therapies have been approved by the Food and Drug Administration, and they're bringing in real revenues. Again, I think Roche, who owns Avexis, no, I'm sorry, that's Novartis. Novartis, who owns Avexis, and that provides a pricing model for a gene therapy. So then in that case, getting more into your accounting background, more so finance, but you take the number of potential patients, assume they can't reach all of them, maybe let's say 50, 60, 70% ratio. You know about how much they're going to charge because it's still cost saving, because again, the price of infusions for someone who has hemophilia B, that's $500,000 to $700,000 a year, assuming they don't get hospitalized. By the way, if someone has hemophilia and they're hospitalized, that's going to be $1 million stay to get that fixed and sorted out, unfortunately. So I think the important part of what you're getting at is that, your accounting background is really great. It really is. And there's a style of investment that you can cultivate based on that, which is really, I wouldn't call it fundamentals, but it's based on the financials. I'm sure there's a term for it that's escaping me right now. But just remember, that's not the whole picture. There's more to companies that are what's in the SEC filings or what their cash flows were the last quarter. The same way too, if I gave you a production schedule for a country during the Second World War, I wouldn't tell you anything about the tactics in the field or who would win which battle. So when you invest too, and maybe this is a bias towards myself, I'm more of a qualitative thinker, you need to be looking at the bigger picture and understand, again, the non-quantifiable forces at play here. But generally, no. Recession fear-mongering, speculating what the next big industry is going to be, it works for some people, but I think generally the people who only talk about that and don't talk about the financial ratios like you were mentioning aren't very intelligent. But at the same time too, that's what also everyone talks about, the big recession coming up. And I was holding cash, and I think that's fair to mention because we're just discussing my portfolio, and I think there's nothing wrong with making yourself prepared for that. Now onto your other question. You say, this is a specific question. I'm buying a dividend-focused ETF. If I'm buying a dividend-focused ETF, should I worry about growth of the ETF, or should I not really worry at all about it and just focus on the payout? Well, my answer to that is obviously it depends on your goals, right? So, first and foremost, if you have a good stream of income from a job and you're investing for the long term, maybe growth is better for you because you don't need the money immediately. I will tell you, in my scenario, in my situation, I have a different life than most people. I don't have a job, really. My job is I run just a ton of YouTube channels, and their income is so volatile. I like living abroad. I like enjoying my younger years. And so to me, income investing, as in getting as much cash flow out of my investments as possible, is important to me because it subsidizes my lifestyle. Now, many many ETFs are focused on dividends. The ones that come to my mind are SCHD, VOIM, SPHD, and all of them have a decent payout as well, but they grow. And then a counterexample to that, which is more of a payout-focused ETF, would be SPYD. But at the end of the day, neither of those really matter. What you should be looking at is the yield to date, or the annual yield, and that factors in dividends reinvested and also the growth of the underlying assets. And so whatever has the best annual yield is probably what you're looking for. Now, obviously, that will change in different sort of economic environments, right? So more growth-focused ones might hurt more in a recession or vice versa. But of all the metrics to look for with that, whether it's growth or income, remember, number one, it's your objectives, and then also number two, I would focus again, what's the annual yield? That doesn't lie. There's no hiding from that figure. But there's more to it as well. I assume, having an accounting background, you understand the difference between a qualified and an ordinary dividend, and there are tax consequences, and you're going to have to handle all that on yourself. Just at a very broad level, I think I can just explain more generally, again, a growth ETF, a growth dividend ETF, or just a dividend ETF. How do you quantify what makes a good trade on dividend-paying stocks? Well, trade, I'm not really sure if that's the best way of looking at it, right? Because I assume most people who buy dividend stocks are in it for the long run. You want to hold it for a long time. For example, dividends don't even switch from ordinary, which is a worse tax treatment, to a qualified dividend after a certain holding period. And I don't think people are really into trading dividend stocks. I know some people like to scalp dividends, but that's not a strategy I'm too familiar with. And this varies person to person, but generally speaking, it's about the better entry you can get, the best price entry you can get. And there are ways of looking at it. There are metrics you can look at, such as payout ratio, and that obviously determines how well the dividend is covered. If you're an accountant or you have a background in accounting, you should be able to look into the metrics and see how well the dividend is covered, whether they're actually issuing debt to pay it, or whether the revenues actually do genuinely cover it. And then you go on to say, as long as they're still paying dividends, is that all that matters? I mean, no, not necessarily. I think most people do actually want their underlying share prices to grow as well. If you just want a full cash flow thing, there's one I'm familiar with. I'm not a fan of it, but there's one called QILD, which is I think it's a covered call ETF, and that's just pure cash flow. I'm not a fan of it myself. I don't own it. In this case, to answer your question, again, it depends on your objectives. I don't like stocks that obviously crater, and obviously a dividend isn't the be-all, end-all of the world. And frankly, if someone has, again, a job and an income coming in from that, they don't have to worry about high yields or dividends as much as I do, because I need the cash flow to support my lifestyle. You'll find too that many stocks, as they crash and go down or the share price depreciates, they'll cut the dividend as well, where the percentage payout still stays strong on paper, but the amount is going down. So in that case, obviously, I recommend looking at the historical data, Yahoo Finance, anywhere else, and just see, is the dividend maintaining? Is it going up? Is it being cut? All of those are very good questions to answer. And so broadly, again, the answer to this question is it depends on your objectives. Finally, you say, maybe I should have gotten a finance degree instead of accounting. I understand how to read a company's annual, quarterly reports, etc. I just don't completely understand how to start applying the knowledge to investing. Well, so here's the thing. I think the first way to go about this is you have to ask yourself genuinely, what are your goals, right? So your goals, I want to save up for retirement. I want to be super speculative. I want to strike it rich. I want cash flow to support my lifestyle. I want passive income. I eventually want to retire early. Those are just three. There are more possibilities. It depends on your objectives. I would say, you have a very strong background, and I wouldn't be too worried about it. The general advice, like on obviously the various investing and personal finance forums, is to do an ETF. But before you can even possibly move forward on that question, you need to take a moment and seriously think about what your goals are. So I will take you from beginning to end about what my goals are and how that affects my investing. So here's my background again. My income is extremely volatile. My job is YouTube. I run a bunch of channels. Their ad rates spike up. There are feast months, and then there are famine months when channels get shut down, demonetized, or they die off, or whatever. So I like living in a broad traveling lifestyle, and I also need to pay the daily bills. And so as a result, dividends are important to me. So I invest in strong dividend companies. So to give you an example of ones that are in my portfolio, I own AbbVie, and then also I own dividend-paying ETFs like VYM, the Vanguard one, SPYD, SCHD, etc. And so some of them are growth dividends, and some of them are just, pure dividend players as well. BDCs are a good example of that. But then at the same time, too, I am an aspirational type person. In the same way I love building up channels and, again, doing more and more and more in my career, if you're calling it, one of my goals is to become a millionaire. And so that also at the same time drives me too, as well. I need to take care of my day-to-day living expenses with cash flow and then hopefully grow that portion of my portfolio as well. I want to be a millionaire, and I think I have the right mental architecture for you, if you will, for that. Because I have a really strong background in history. I understand the general trends and concepts in the past very, very well, and all that's qualitative. And so when you kind of apply that to businesses, no different than you're saying, this monarch in history, he had this personality disposition, and because of it, he drove to the army to win this battle, this internal reform. A lot of that's personality based. And so you can do the same thing with companies, executives, board of directors, their strategies, etc. And also, too, it lends itself to understanding sociology as well. So there are people who are visionaries as well and who understand that society will change in certain ways. So, for example, to use a really cliche example everyone knows, is Elon Musk. He knew that gasoline is antiquated. And if someone can create an electric car, or really just using electricity as the backbone of transportation and everything else, that could work, and that could change society. So just remember too that people who are speculating on the next big industry, yeah, a lot of them are, really just being honest, a lot of them are stupid. But at the same time too, there isn't much of a difference between someone like me at the sidelines realizing, oh wait, this is big, this is going to change things. So an example of, in my opinion, gene therapy, versus the people who actually decide to research it and go to develop the actual technology, right? So they're not really speculating themselves. I mean, just think about what's the difference between a researcher and an inventor, or someone who just realizes that research and invention is the real deal. There's no shame in that. There's no shame in speculating on a sociological, macroscopic level how society is going to change, because people get rewarded for doing that correctly. I just think that sort of investing is tainted because there's so many people who, again, blindly believe in Bitcoin or blindly believe in weed stocks or whatever. And so, that drives me. I make very focused strategic investments, in this case, in gene therapy companies. It used to be just more generally pharmaceutical companies. I'm not going to try to inspire anybody with false hope or anything, and I'm not obviously going to talk about too much about what I'm doing because I don't want people to blindly follow me. But there is a place for speculative investing on massive social and technological shifts. So what I want you to take away from this video is that, number one, I hope I helped you. And then number two, I really hope you get a good idea of what your goals are and then build your strategy from that, rather than trying to understand the entire investing world, which frankly, it's going to take you probably a decade to do that, even really just to get the water up to your knee, if you will. So I hope you start from your goals and you do something from that. I really do appreciate the comment on this video, or on my previous video, and it's definitely helping out the channel. And I'm glad to see the interest in my videos and my way of investing, because I found on YouTube that, as your comment was kind of alluding to, there's a severe deficit of channels that I think have substance to it. A lot of them are flash and panaz, and I can tell because you have an accounting background too. It's transparently obvious they don't understand anything about corporate financings or basic accounting. It's really crazy. Not that there's nothing wrong about that. I mean, people who are only qualitative investors, they can do well as well. But the YouTube investing space definitely leaves a lot to be desired. So that's all for now. I hope you check out my other videos, everyone watching, and also, if you can, support the channel. I have an affiliate link to M1 Finance in the description. You deposit $100, you get $10, I get $10. That's a 10% instant gain for you. And I hope to see you all in the future.